Welcome to the B.F. Anderson Technical Report for May the 14th. Look, the economic news is bad. Unemployment is high. We all know that. The market knows that. I think the most important thing to understand about trend following and the strategies that go with it is that what we're doing is we're looking at historic data. Now, there's a lot of arguments out there that this time is different, that there's no way we can look back on history. Well, I disagree. Human behavior has a lot to do with what goes on with the markets, and human behavior just doesn't change that much. I mean, if you go back to Roman times, you can find human behavior similar to where we are today. So we do believe that the historic data is saying that the market has put in a low, that basically the worst is over as far as the downside. Now, we're going to base this on a study that I'll get into here in a minute, but let's see how we look right now today. Again, we do believe, or the data does say, now this is not an opinion, this is just what the data says. You see, my opinion means nothing. Your opinion means nothing. The market is going to discount the future, so that's what you've got to really pay attention to. So what we're seeing here, and I want you to note this, we have gotten a golden cross on the 25-day moving average going above the 50. Now, this is on the NASDAQ. This is clearly the strongest index of all the indexes that we follow. The NASDAQ is leading the market, and it's very narrow, meaning that it's primarily technology, biotechnology, and healthcare. Forget about retail, forget about transportation, so forth. It is primarily technology and healthcare. So if you're in like a large, broadly diversified index fund, that's going to be a problem because they have positions in these industries that just are not performing. So basically what we see here is that the NASDAQ is above both moving averages. The lower moving average has turned up, and we have gotten a golden cross. So it looks good. Now, on a weekly basis, we have to remember that the 35-week moving average is very similar to the 200-day moving average, and we have gotten back above the 35-week moving average, and we're now above it and closing above it for 5 weeks. That's very constructive. Now, one of the indexes that are just not really doing that well, and this is again a monthly graph. We're looking at a long-term graph here of the small cap stocks. This is the S&P 600. So you can see we're on a death cross. The moving averages are continuing to move down, and the index has really got a lot of white space that it needs to recover from. So the small caps are just not outperforming, which would be a very positive thing if they would. Now, on the S&P 500, again, using a long-term graph, which is monthly, we are on a golden cross. There's no death cross. However, the index has pulled down below the lower moving average. The S&P 500 is not doing as well as the NASDAQ, as you can clearly see. Now, here's the NASDAQ. And again, you can see how much improvement in the performance of the NASDAQ above relative to the S&P. You're on a golden cross. However, the index is above the upper moving average. Again, this is all being driven primarily by technology, and specifically mainly communication and software technology. Now here's China. This is the golden dragon, which is all the Chinese stocks that trade in the United States. Just recently gave a golden cross, is trading above the upper moving averages. I think we need to watch China because as they recover, I think that will give us a heads up on how our recovery will take place. Now, this is impressive. This is the most impressive graph. This is the aggression index. This is where we're taking a ratio of the NASDAQ, which is super strong, and we're comparing it to consumer staples, which are super defensive. So aggression, this is showing are investors aggressive here. This is actually making a new high since this all began and is in a very good uptrend and the moving average that we're using, which is the 50-day moving average, has turned up. Now, if we look at it on a weekly basis, same thing. We're seeing the lower moving average turning up, the aggression index is zooming, and it's basically because the NASDAQ is outperforming. So if your portfolio is emphasizing technology, you're in pretty good shape. Now, on the economic indicators that we're following, this is interest rates. Again, interest rates are flat. There's a lot of talk of the Federal Reserve might go to negative rates and so forth. But, don't fight the Fed. The main rule there is just don't fight the Fed. And that might be one of the reasons that the market put in the low that it put in back on the 23rd and then started to rally because the Fed is so accommodative. Now, here's oil, West Texas Intermediate. Again, starting to flatten out a little bit here, but improving. Small caps, as we noted, are just continuing to lack any kind of upside potential. Now, on sentiment, fear and greed. We got extreme fear back here around March 23rd. Now we've kind of pulled back into a normal zone. We want to be careful that if we start to see too much greed, we want to be defensive at that point. But we're pretty neutral right now on sentiment. Now, I did see a report on sentiment that was interesting that basically says, this does look like a bottom. Now, here we have again, I wanted to emphasize the fact that the 25-day has moved above the 50-day. This is the S&P 500. However, kind of flattening out a little bit here. We're not getting through that 200-day. So if the S&P were to break above 3,000, which would be a break above the 200-day, that would be a very positive sign. Now, one other thing to kind of measure here that we want to look at is the number of new lows on the NASDAQ. Now, you can see here, extreme number of new lows back here in March when things really got nasty. We had one day where we got up to 2,100 new lows. Well, you can see that has really contracted. Now, yesterday we had 95, but it is really, really contracted. So, in other words, bunch of fear, things starting to normalize. So that's the way to look at the new lows. Now, on the new lows for the New York Stock Exchange, basically the same scenario. Bunch of fear. Now it's starting to stabilize. We're going to get back into a bull market at some point. It's just when. Now, this is a study that was done by a friend of mine that really is interesting. Now, what we're going to introduce here is something called the rate of change. Now, this is a weekly graph. And what we're measuring here is the rate of change of the S&P 500 over a 7-week period. Why 7 weeks? Well, that's another story that we just don't have time to go into. But my point is, we have gone back and looked at every market bottom since 1950. And if you just boil it down, there's really only 2 times that resemble where we are today. One of those times would be 1987, the crash of 87. But the overwhelming example is 2009. Now, you can see here what happened was the rate of change of the market went down dramatically and then snapped right back. Took a little bit of time, but you can see here that down and then back up again. And that, if you look over a 50-year period, 1987 was the only other time that would have happened. Now, here's where we are now. We got a rate of change dropped dramatically. Now, realize now, this is the market discounting the future. So then we got to rally back up again. So what the argument here is, or the speculation is here, is that this bottom is very similar to the 2009 financial crisis. So if we just take a minute and look at the formation here and the steepness of the drop, then the rebound looks very similar to the 2009 period. Now, if we go to 2009 and we study the NASDAQ, just like we pointed out earlier multiple times in this video, we've gotten a golden cross, and this would be this date right here correlates with this date here. So that's where we are now. So we're looking at history, and history is saying that the low was put in back in 2009 here, and then we started to have good things happen to us. Hopefully that's the case. So let's get into the top 5. There's some interesting stocks that are starting to perk up here or have been perking up. This is a company called Moderna. Now, we all know how important it is that we get a vaccine for the virus. Now, that would basically mean a cure. However, that's kind of a long shot from what I'm hearing, from what the medical community is saying. But with Moderna, they have just completed phase 2 of a vaccine trial. And the purpose of phase 2 is to determine the safety of the vaccine. Now, they're moving on to phase 3, which is where they're going to determine how effective the vaccine is. There's going to be something out there. And what is interesting here is you've got to realize this stock broke out at $20 a share and is up here around 65. So the stock is basically tripled. Now, the market is telling you they got something. So we need to keep an eye on Moderna. Now, this is gold. This is Newmont Corporation. Again, gold. One thing I always try to think about when I'm investing is that, what is the speculation here? Now, with Moderna, for example, the speculation was, okay, they're going to come up with a vaccine. Well, with Newmont, we're speculating on the price of gold, and I just don't understand the speculation. So therefore, I'm not really a gold guy. I would just simply say that gold is acting constructive, which is really not the best thing, but it is happening. We just got to face the reality. This is PayPal. Again, think about speculation. PayPal allows e-commerce merchants to have a payment system that is very easy to use. I use it all the time. My family uses it all the time. So basically, PayPal came out with earnings. It actually missed estimates. However, they gave such a promising, they added 7 million new customers in the month of April. So that tells you something. Stock gapped up, has pretty much held the gap. Hopefully that continues. We do own PayPal. That's a stock we do own. Shopify, kind of the same story. PayPal and Shopify tend to work together because Shopify is a software platform that allows merchants to have an internet store. So they use the Shopify platform, which is all the inventory, all the pictures, and then, the ordering process, and then you can use PayPal to pay for whatever you're buying. But you can see here a very, very powerful uptrend. So e-commerce, I think it's here to stay, and I think brick and mortar is on the way out the door. Now, here's Twilio. Twilio came out with earnings, major gap up, big volume, is in a very strong uptrend. Now, this is a communication technology. So when you go on a web page and it says, would you like to chat? You can chat with about typing with whoever is, the web page is with. Now, my speculation is that we're going to see more things like video chat, where people will be able to say, get on, say you want to go to Orvis's webpage and you want to chat with them about merchandise with a guy you can see the merchandise and talk about it. So Twilio is really a new wave in communication. So basically that's it. Hopefully the data is telling us correctly that the low has been put in. So let's just be patient. And if you have any questions, please let me know.